So why does it matter that banks create money? How is that shaping our economy and our world? And again, the reason we're asking these questions is because there is a body of scholars today that are telling us that the way money is created today is intensifying economic hardships, social issues, and environmental concerns. And specifically, they are talking about the way money is created today, which is through banks creating money, as we've talked about before. Now, whether or not that's a problem, or whether or not you think that the banking aspect of it is a problem, is up for you to decide. We're just preparing these presentations so that you can have a strong enough understanding of how the system works to be able to judge for yourself. So what's ahead? In this presentation, you're going to get a new understanding of the relationship between money, banking, and the economy. It may not be new for you. There are some folks for which this is a shared understanding. But what we know from research is that the vast majority of people do not have the understanding of the relationship between money, banking, and the economy that we're going to share today. And we're also going to talk about how the outsourcing of the money creation to commercial banks profoundly shapes our daily choices, communities, economies, and the planet. And then we're going to talk about how some small tweaks to the bank money system can produce big and positive changes, and not just in theory, but in ways that have really been done in large industrialized countries in recent times, including at present. As always, these presentations are based on a lot of scholarship, so please check out the references in the description. If you've seen some of the previous presentations, just a quick recap if you haven't, we talked about how today's money system emerged from accounting, not from coins or feathers or shells or something like that. This system can be traced back about 5,000 years to Sumerians and Egyptians. And in fact, the invention of coins or physical money only occurred about 2,000 years ago. And today, our national money system marries those two things in an accounting system that's based on banking, with banks being the accountants, and also physical notes and coins. And that's the particular money system that we have today. It isn't the only way that money can work. And that's very important to name because there are many alternative and indigenous money systems and other things that have been displaced by this system. But today, through various politics, this is now the system that's used around the world. So we've also talked in other presentations about the accounting, like how exactly do banks create money in their accounting, and also the laws. Why is this legal? And then also, why have lawmakers made it legal? Why would governments give away the privilege to create money? So today we're going to go through three parts. The first part is how money flows in and out of the economy, how money creation shapes the economy, and then those small tweaks that can shift the flow and shift the economy. So as I mentioned, what we're about to share is what I like to think of as a bit of a Copernican revolution. Copernicus was the one who said, wait a minute, the Earth is circulating the sun, not the sun circulating the Earth. And for many people who have come into a full understanding of bank money creation, that is the experience. And you can tell me if it's true for you as well. And here's what the research shows, is that what most people believe, and it's what we at the Money Justice Collaborative believe as well, is that the economy is made up of people and firms that are passing the relatively fixed amount of money back and forth in trade and investment. And that the government created that money that's being passed back and forth, and that the amount of money in circulation is relatively fixed, right? So outside of emergencies like the COVID pandemic, the government may add money to circulation through deficit spending, but this is a bad thing to do because it always causes inflation. Right? This is the common understanding. And we believe these things because it is what is taught in best-selling textbooks to this day. And as you saw in one of our earlier presentations on the accounting, this is acknowledged by central banks like the Bank of England that the textbooks are not accurate on this point. So for example, here, this is the circular flow diagram. It's the first figure in many introductory economics textbooks This one is taken from the best-selling economics textbook in the world, Principles of Economics by Gregory Mankiw. And what it shows you is that money is circulating in a closed loop between households and firms. Now, that is like the picture that I just described, right? We have a relatively fixed amount of money. There's not a lot being added or taken away, and we're passing it back and forth between businesses. So this is the understanding that most people have of the relationship between money and the economy. There's just one big problem, as we talked about before, and the Bank of England highlighted this problem very well in a famous paper called Money Creation in the Modern Economy, and that is that whenever a bank makes a loan, it creates a deposit in the borrower's bank account, thereby creating new money that did not exist before. And if you understand that one fact, and we have entire videos explaining exactly how that's true, why that's true in accounting and law and so on. But let's just say right now that this is your first video. If you just accept that that's true, that every time a bank makes a loan, it's creating new money, new deposits that are being put into the economy. That's all you need to know that that picture that most of us are walking around with of the relationship between money and the economy cannot be correct, right? It cannot be a closed system. There has to be another faucet through which banks are creating money when making loans and putting that into the economy. And as you also know from your own experience, banks are making loans all the time in good years and in bad years, right? So this faucet is one that is constantly flowing, unlike the government one that we're expected to believe that it is only flowing a little bit and infrequently. So how big are these flows, right? The quantities of money being added through bank money creation in a given year are huge. Just to put it in perspective, in the United States between 2016 and 2019, if you went and looked at the Federal Reserve statistics on the amount of money in circulation, it would have averaged about $14 trillion. But during those 4 years, banks actually issued loans worth $21 trillion per year. Just to put that in perspective, $1 trillion, you will not have spent $1 trillion if you spent $1 million every single day for the next 2,500 years, right? So every year, the banking sector of the United States is putting 21 of those trillions into circulation, newly created money. Now, obviously, that's a little strange, right? Like, if banks are creating so much money when making loans, the economy should be overflowing with money. The Bank of England's bulletin tells us why this isn't happening. And that is that when bank loans are repaid, the accounting process that created the money for the original loan is simply reversed. This means that the principal repaid is simply deleted from the economy. So in other words, huge amounts of money are being created every year, and huge amounts of money are being deleted every year through loan repayment. And again, we have an entire video on the accounting that shows why this is and how it works. So now this runs a little bit counter to the story that we constantly hear in the news about the government, controlling the money supply and printing trillions of dollars after the 2008 and during the 2020 COVID pandemic, and that this is what induces new money creation. And it is true that there is a way in which governments can induce an increase in the money supply, largely by acting like very large borrowers. But those inflows are comparatively small. So look, for example, at the COVID stimulus, which was $2.5 trillion over 2 years, and compare that to the every single year, $21 trillion by being issued in loans by banks, right? So that's why we're going to put some emphasis on the bank loan aspect of it, both because of the volume, but also because of its persistent nature and the fact that it's a major part of what actually constructs our economy through investment in building factories and farms and so on, as we'll talk more about. But what this means is that the amount of money in the economy is not a fixed sum. It's not even a static quantity. It's a flow of money going from creation to deletion. And that flow means that basically the total amount of money circulating at any given time is determined by how fast banks are lending and how fast loans are being repaid. And so the amount of money in the economy can go up and down depending on what's happening with bank lending. And this can be really significant. It's actually one of the things that I pointed to, that the scholars are pointing to, is that this system can create a very fragile financial system and therefore can create economic crises. So, for example, when banks become scared to lend or are unable to find willing and creditworthy borrowers, perhaps because they're at the top of a real estate bubble and nobody else wants to take out or can take out more loans to buy more real estate, the results can be disastrous for the economy. So, for example, in the Great Depression, banks stopped lending at the onset of the Great Depression, and the money supply dropped by 30% over 3 years, leaving families and factories and farmers to operate with 30% less money in the economy. You can see why that caused a real crisis. In the 2008 crisis, the money supply dropped by 20% in 2 years. But that drop was masked due to heavy borrowing by the Federal Reserve. So the real economy lost a substantial portion of money, but the Federal Reserve created or induced a lot of new money in the financial sector. And while that money didn't necessarily reach the real economy where people were losing their jobs and their homes, it did cover up the drop in deposits that was taking place due to a decline in bank lending to the real economy. So this system is fragile. It has this non-static or money supply that can go up and down suddenly, presents a risk for the economy, and many people have criticized it for that reason. But really, also an important thing to think about is just that flow is so large. If that flow is so large that it can cause those types of bumps in the economy, right? Then it makes sense, and maybe a more accurate way to think about the relationship between money and the economy is that money is spinning the economy. The flow of money from faucet drain is spinning the economy, not that the economy is spinning the money supply. This isn't to say that there isn't transactions happening at the local level between businesses and households and so on, but that the economy as a whole, its performance, its activity, its capabilities is being spun profoundly by the flow of money going from the faucet to the drain, and perhaps even more so than that circulation that's happening, at the local level and so on. And again, the circulation at the local level isn't what caused the 2008 crisis, right? There were still people wanting to buy cars the day after the stock market crashed and buy houses and so on. What stopped was the investment flow coming from the banking sector, right? So this isn't a crazy idea. And of course, this is a simplification, right? This idea that it's better to think of the money supply as spinning the economy than the other way around is a simplification. But the question is it a more useful or more accurate simplification than the picture that's given to us in economics textbooks of a fixed money supply that's circulating with no faucet and drain to explain the Great Depression and the 2008 crisis, right? So this claim that the money supply is spinning the economy is something that is also supported by some economics research that shows that, in fact, economies slow down and speed up in relationship to changes to the inflows and outflows of bank money creation. So there's close correlations with things like GDP. Now, importantly, this relationship between money creation and the economy applies in countries around the world, not just in the United States. I've been using that as an example, but we've looked at Germany, Romania, Morocco, and many other countries. And these same types of relationships, huge amounts of money creation and deletion relative to the quantity of money in existence, and close relationships between money creation and GDP. And this is true for countries that one of the reasons I mentioned this is because a lot of people say, well, wait a minute, in my country, we use a lot of cash. We don't use banks. In fact, a lot of people aren't banked. But even in a country like Romania, which has one of the highest cash utilization rates in the world, the money supply is actually turning over every single year. There's more money being created than is in existence. And as you'll see, what that means is that those people that are just using cash are not the ones that are the primary beneficiaries or the primary ones channeling the investment coming in from the banking sector. It doesn't mean that the banking sector isn't creating a lot of money and that isn't shaping their economic life. Okay, so part two, how money creation shapes the economy. Now, it's really important here. I said how money creation shapes the economy. I didn't say how banks shape the economy, because ultimately, at the end of the day, it isn't banks that are responsible for the shape of this or for the way this money system works, in the sense that it is our governments that have endowed banks with the extraordinary legal privilege to create deposits. It was not inevitable that our governments would outsource the money creation decision-making to banks to exercise when making loans. So I just want to emphasize that, because from here on, I'm going to be talking about what are the consequences in the shaping of our economy that happens when banks are the ones that this has been outsourced to. But I'm not necessarily blaming banks. Banks are doing what banks do, right? They make profit through lending. But these are the consequences of the decision to outsource the legal privilege to banks. And as we have an entire other video about, there are certain legal privileges, accommodations, and laws that do this outsourcing. So really importantly, I just talked about how the modulation of the volume of bank lending can really influence the economy as a whole, but it's not just the volume. It's also the discretion that banks are exercising whenever they're making lending decisions, right? They're always choosing between lending to this or lending to that. And that has an effect on the economy. And these decisions are influenced by individual loan officers, but more importantly, by the strategies and policies of management, right? That are deciding, hey, as a business strategy, how do we want to lend? Are we going to lend in rural communities? Are we going to lend to low-income communities? Are we going to lend for housing construction? Are we going to lend to small businesses? Or are we going to focus on large corporations where we can do fewer loans that are a lot bigger and make the same amount of money with less work? Or are we going to lend to the stock market for hedge fund speculation, where we have really short-term, returns on profits versus making long-term bets of 5-year loans on a factory or 30-year loans on a mortgage? Or are we going to lend for mergers and acquisitions so that we have, ever bigger corporate monopolies that, are our big customers for us, right? And again, I just want to emphasize that when management of banks are making these decisions, they're making it on the reality that they are legally obligated to maximize profits for their shareholders. They're not really they're not only not obligated to, there are court cases that say they cannot take into account the needs of rural communities and prioritize that when they would make more money for their shareholders lending somewhere else, right? And so this is a concern, because if we have a money creation system for our nation and we're putting it into circulation in a way where the needs of communities that may also need the opportunity to borrow money in order to make new businesses and bring new ideas to market, but they are not as profitable and therefore do not get the opportunity to borrow, maybe this is a problem, right? So this is something that some of those legal scholars have pointed to. But also it means that things that don't actually make a profit at all, like providing education, for example, is not one of the things that we can be funding with new money creation through banks, because banks can't just create money to pay for public schools, right? They can only pay for public schools that could pay them back plus interest, right? So importantly, these lending decisions, as I just mentioned, are driven by profit motivation. So what that means is that we get on the left side of your screen here, we get a lot of money investment flowing into growing things that are really profitable. So right now, for example, fossil fuel production is more profitable than renewable energy production. Maybe that'll change in the future. But for the last 10 years, since many countries have been trying to get off of fossil fuels, money has continued to pour from bank money creation into the fossil fuel industry. The same thing with luxury housing. Many people would love to see more money, more investment flowing into affordable housing. But in our current system, newly created money in the housing sector overwhelmingly goes to above market rate housing, which actually pushes prices up because it's more profitable for banks. Big businesses are more profitable, speculation more profitable, import export is often more profitable than making 5-year loans to produce a factory, to build a factory that would reduce imports. And so these are some of the ways that having money creation come through the banking sector is shaping the type of infrastructure that we get, the types of businesses we get, the types of local economies we get. But some of those scholars that I pointed to earlier also point to social issues that are implicated in this. So, for example, inequality. When a bank wants to lend, they'd prefer to lend to someone that's highly credible or creditworthy and has a lot of collateral, a lot of wealth that they can put up against the loan to ensure that the loan gets repaid, right? So that's your high income households, your high wealth households, your big corporations. It's much easier for them to get a loan, right? Let's say that there's a multifamily, house, apartment building for sale, and you have a high wealth, household go and take out a loan to buy that multifamily housing unit and have it be the landlord and earn profits off of it going into the future. While the low income household members, or maybe even medium income households living in that apartment building, are the ones generating the income flow against which that loan is justified to the bank. It's their income flow that's paying the rent that's going to justify the repayment of that loan and therefore the making of that loan. But because they don't individually or collectively have an asset to put up or income to guarantee the loan, they can't go buy the apartment building that they themselves are paying for, right? So this is a way in which it reinforces an inequality that's already in our system versus balancing it out. And just to take that to another level, this inequality forcing is gendered. We know that high-income households, high-wealth households, and big corporations are more frequently headed by men than by women, and that's also goes to people of color and other communities that are marginalized. This system is by virtue of prioritizing or preferring borrowers that are already with wealth and high incomes, is deepening inequality in a number of dimensions. So it's really important to recognize that every one of these lending decisions is a green light, red light decision. And across the economy, they are collectively determining what investments, what receives investments from newly created money, right? We're talking about newly created money here, and what does not receive investment, right? There may be other sources of investment, mutual funds or private equity funds or something like that. Here we're talking about money that's newly being created, where those other funds are circulating, pre-existing money. And so this powerfully influences what parts of the economy grow and don't, as I mentioned. But just to really drive home that point, this is a huge amount of influence. $21 trillion per year between 2016 and 2019 was greenlit in lending by banks. We don't have any idea how much banks redlit during that same period. It could be $60 trillion or $60 trillion. It could be $20 trillion. We don't know because banks are not required to report what they do not lend, what loan applications they reject. And this is, there are people who pointed to this, scholars and others said, hey, this is a real problem because it means that we don't have any way of actually evaluating whether or not banks are being fair to equal lenders or equal borrowers, I should say. And it also means that we have a problem in terms of managing our economy. So just to put this in perspective, in the 2008 crisis in Spain is one of the only countries on the planet that actually does require banks to report the loan applications that it receives and then which ones it accepts and which ones they reject. They were able to show that in fact, in the 2008 crisis, it was not that businesses got scared or households got scared and stopped trying to borrow from banks. It was the exact opposite. Banks got scared and stopped lending to businesses and households. So they were able to show this because many going, profitable businesses that had always been able to show up to the bank and get a loan to finance their inventory or their next construction project or whatever, were showing up with the loan applications. They're profitable enterprises. They would have gotten their loan, the balance sheets looked the same and so on. And they suddenly were going from one bank application and getting the loan to applying to 6 banks and not being able to get a loan, right? Same profitable enterprises the day before. So ultimately, another complaint or concern that some of the scholars that I mentioned have raised is a question of democracy. Ultimately, the decision makers in this money creation system are bank executives and loan officers, right? And so some people have argued that giving unelected people the power to allocate newly created money, especially at such huge volumes, but even if it wasn't such huge volumes, that is undermining our democracy. We're giving unelected officials or unelected people a profound influence over the shape of not just our economy, but actually how our communities are structured, what choices we have in terms of housing or fuels or whatever. So just to put a specific story on that, we have right now, since 2015, a number of countries, most of the countries in the world, commit to decarbonizing their economies, so phasing out fossil fuels as fast as possible. And then many of them are democracies, right? So these are democracies that established policy commitments to do this. And yet those democracies have outsourced the bank money creation privilege or the money creation privilege of their countries to banks. And since that time that they made that commitment, we know from the data, there's an excellent several reports. One of them is Banking on Climate Chaos, which comes out every single year, looking at the bank lending to the energy sector. But there are others as well, one cited here. What we know is that since that agreement was signed in 2015, the banking sector has lent 93% in the energy sector to fossil fuel companies and fossil fuel expansion projects. Only 7% has gone to renewable energy. And this is what scientists are telling me we need to be on track to avoid 1.5 degrees Celsius warming, or rather to stabilize that. We need to be doing 86% renewable energy investment in the energy sector no later than 2030, but really getting there much faster. And right now there's pretty much complete agreement that if something radical does not shift in the investment flows into the energy sector, we have no chance of meeting 1.5 degrees Celsius warming. So again, I just want to emphasize, when we're talking about these types of decisions, we're talking about the everyday banks that are in our cities. We're talking about Chase Bank. We're talking about JP Morgan Chase making a huge amount of red light, green light decisions. In this case, the example that I just gave with fossil fuels, that have been steering us in the opposite direction of what was our public policy commitment until the Trump administration took us off of the Paris Climate Accord. But in other countries remains the policy commitment of their democracies. So just to bring home that point one more time, that this money creation flow is literally constructing our world. 70% to 80% of all borrowing by corporations comes from bank loans and lines of credit globally, bank lines of credit, right? And this is in particular the types of borrowing that corporations do for building factories, for buying capital assets, for buying inventory, and for making investments that are what are called the capital assets, that are the structure, the buildings, the factories, the equipment that make up our world, the real estate, the office buildings, the residential spaces, and so on. Only 20 to 30% comes from other investors, like your mutual funds and so on. Most of the money that's being invested and lent by your mutual funds, your private equity funds, and so on, is being circulated out of pre-accumulated savings, and it is going into what's called the secondary market. it is buying bonds and stocks and so on from other investors who previously bought the bonds and the stocks. Only when those initial investments are bonds or stocks are issued by a corporation does money from that market flow into corporations. And what I'm saying here is only 20 to 30% of the time that corporations are raising funds to build stuff, are they issuing bonds and equity, or are they issuing investment opportunities for that secondary market? So this is one of the most important flows in the financial sector. It's not to say that those other flows don't have any impact on what corporations build or do. I'm just saying that this one is particularly important, both because of the scale of it, but also, as we'll come to more again, is that this is all rooted in a legal privilege to create money, whereas those other ones depend on actually accumulating and circulating pre-existing money. So it's of a different nature, both in terms of how the money is coming to these investments and the structure of the legal structure by which it does so. So again, here we go. When we're getting fossil fuels, luxury housing, etc., this is what I'm talking about when I'm saying that this is structuring our environment. Now, we don't really see this, even though it's happening every single year. And the big reason we don't see it is because every year it's happened. The allocation is being made on basically the same logic as the year before, right? So we don't notice that the faucet's raining on the same thing or shaping our world by raining, on certain industries, because it's happening the same way every year after year, every year. But let's just do a radical thought experiment and say, what if we just switch these numbers for 1 year? For next year, we're just going to take all the numbers and just flip them. So the amount of money that's going in the fossil fuel industry last year is going to go into the renewable energy. And the amount of money going into luxury housing last year is going to go into affordable housing. And the amount of money being lent to big businesses is going to go to small businesses. And the other ones will get the reverse. The fossil fuel industry will get the amount that the renewable energy industry was getting, and so on. What that would look like, just to take the energy sector alone, is that this year it's 93% going to the fossil fuel industry. And next year, it'd be 93% going to renewable energy. That's a 13 times increase in the investment flow into the renewable energy sector. So even if we did that for just 1 year and it only lasted for 1 year, you can see that millions of jobs would get created in the renewable energy industry. We would get, better and more resilient energy infrastructure built next year. We would get housing retrofits done to make houses more energy efficient, and maybe some independent production of energy with solar power and so on. It would reduce energy costs and do rapid decarbonization, right? And so if you can imagine that just 1 year of just switching those flows would produce such a huge economic shift, not only in employment, but what is getting built through that, that helps, I hope it helps you understand what I'm talking about when I say that this inflow is so influential. Okay, so such a big shift, like I just described, shifting just trillions of dollars or billions of dollars or millions of dollars from one thing to another, is that realistic? And the answer is that, and this is what the legal scholars are telling us, and other scholars who've been looking at this in particular over the last 10 years, is that yes, it's possible. And not only is it possible, it's been done many, many times in many, many countries. And just to give you some starting places on that research, these are 2 papers and a book that give some great histories of some of the countries that have been making some of the changes that I'm about to describe. And one of them, the one on the bottom right, is a paper that then takes those stories of recent practices in countries and says, we could use this to address the climate crisis right now. So if you want to see that type of understanding moving to the present issues, you can see that there. Okay, so part 3, let's talk about what are some ways that this system can be tweaked to change the flow of money and thus the economy. And by tweak, I mean, we're not talking about completely getting rid of an accounting-based money system with, cash and coin tokens, that represent accounting records, in financial institutions. What can we do? Keeping all of that, what can we do to change the flows? And this is Bob Hockett. He's a Cornell Law School professor who's put forward a number of proposals for how to shift our current system. And he has been successful in getting some bills introduced in Congress, right, with bipartisan support. And what he says is that if we target the right parts of the right regulations or statutes with very small tweaks, we can very quickly shift from speculative finance to productive finance, a full public banking platform, or both. And what he's talking about there in speculative finance to productive finance is getting that investment flowing into factories and farms and local production versus speculating on real estate and Wall Street and so on. And with a full public banking platform, he's talking about having bank money creation that is flowing money into public purposes and public priorities versus private for-profit priorities of privately owned shareholder banks. So all of this, what I'm about to show you and what Bob's talking about, depends on understanding that this entire system is changeable because it is rooted in laws, and laws can be changed. So I'm going to give you 3 examples. One is a radical shift that happened in the 1930s in the United States, but persisted and really was a crucial part of the strength of the US economy through the 1970s. I'm going to talk about Germany as an example of a country that in post-war rebuilt their country and using this, and also I should say many post-colonial countries also use these strategies to industrialize. And then finally, just to bring it up to the present and use an example that is really blowing the world away economically, talk about how China has made some similar tweaks and made big changes. So this first one is that you can, while keeping private for-profit shareholder banks operating as they are, you can regulate them like public utilities. So for example, we have in the United States, we have many for-profit electric utilities, but we regulate them like public utilities in the sense that we regulate what prices they can charge. We obligate them to provide service to everyone, even if some people are more profitable to provide service to than others. We keep their profit margins at a reasonable level. And so you can do this with banks as well, and this has been done. This was really what some scholars call the New Deal banking, or the banking New Deal, which was coming out of the Great Depression, where the U.S. government said, you know what, you guys, you banks, you just blew up our economy. We're going to actually take a lot more interest in what you're doing, and we're going to require you to lend at low interest rates and provide service to everybody and at reasonable profit margins and so on. So this system that came out in the 1930s persisted into the 1970s in the United States before there was a lot of deregulation of the banking sector. But again, what they did here was they restricted bank money creation to economically productive lending and blocked lending for risky speculation, Wall Street, and so on. They required that banks keep interest rates low. For much of this period, corporations could borrow at 2% interest. The government could borrow at 0.3% interest, a negative real interest rate, meaning that with inflation being anything over 0.3%, the government was essentially making money by borrowing. And this method paid for employment programs coming out of the Great Depression. It paid for Social Security. It paid for the World War II mobilization. The United States was able to increase its fiscal budget by 10 times in just 2 years. And that's something that was only possible because they understood the ability to control the money supply and through the banking sector and obligate the banks effectively to lend to the government at extremely low interest rates at the exact quantity that government needed to achieve war mobilization. They also required that banks lend within specific regions or within specific sectors. This was called segmentation. And what it did is it required that if a bank wanted to grow, they had to actually invest in their sector or in their region in a way that grew that sector or grew that region. They couldn't just close down shop and go to Wall Street because more money could be made on Wall Street, right? And then they also spun up 45,000 nonprofit credit unions, which are publicly owned, or rather member-owned, not-for-profit banks. Essentially, they also create money when lending, and they were overwhelmingly in rural and working class communities. So that's what it looks like to regulate a private banking sector like public utilities. And as I said, the 1935, Emergency National Banking Act or Emergency Banking Act, laid the groundwork, and then there was implementation of that over 1935, 36, 37, that created that public investment, publicly regulated private banking system. You can also do something like establish public banks as a competitor or as an alternative to your private banks. And this has been done in many countries. The example I'm going to give you here is from Germany. But public banks can be, credit unions, cooperative banks, development banks, state development banks, local government banks. And just to give you a sense, in Germany, to this day, today, 60% of all the banking and lending in Germany is done by public, not-for-profit banks. So they're locally owned public banks that are the retail banks. They're called Sparkasse. It's where I think 85 or 95% of all Germans bank with publicly owned local banks. Then the industry has cooperative banks. So the steel industry has a cooperative bank, the auto industry has a cooperative bank, and these banks are required to only lend in that sector, and they only grow and make a profit when they are lending in that when that sector grows, and their profits actually flow back to the businesses in that sector. And then there's the state development banks, which are owned by the national government, though that's changed as a result of them joining the euro market. They were forced to separate from those state development banks, but they're still not-for-profit banks. Right? And there are scholars who look at the German system and say, this is why German is a global leader in industry and commerce. In fact, Germany has more small businesses that are the global leader in their industry than any other country in the world, including the United States, which is many times larger in population. And the reason is that they have many, many small banks and cooperative banks that are vested in the success of the businesses and the sectors that they are obligated to lend to. And when there's a recession and orders, fall away for no fault of the business, instead of letting them go out of business, they extend low interest long-term credit loans so that they can, retool, retrain, do research and investment and development until the economy comes back up. And then the third example I'm going to give you is converting to a state-owned banking system. And this is the most kind of radical, I'm not necessarily recommending any one of these in the sense that these are options, and there are many options, and you and other people get to choose what you like. But I think it's important to recognize that there's a country on the planet right now that is kicking everybody else's butt in terms of economic development and industrialization and technological development, in how rapidly they're taking over the leading technologies, that has used a system of state-owned banks, which is to say that all of the banks in China are owned by the public governments, and that is both at the national level and the local level. Though their national level banks are profoundly influential and driving much of the economic development. And what they do is they allocate bank money creation, into investments in the economy that are aligned with the policy goals of the Chinese government. And they have achieved a 10% economic growth rate since the 1990s into the 2000s, and a significant reduction in poverty through this way of channeling investment into the economy and money creation in the economy. And to be clear, of course, this is not something I would necessarily recommend, in the sense that this is the highly concentrated economic power that I think is rightly a concern. At the same time, it's just important to recognize that this is an option, and it's an option that is one that our democratic countries are flailing around economically, frankly, in many cases, and not able. And if you listen to the policymakers and treasurers and fiscal policy experts in many Western democratic countries, they look at what China is able to do economically, and with that investment kind of starstruck. Like, boy, we wish we could just channel investment into the things that are, of public priority the way that they can. And so the point is to say, like, well, they could, maybe they'd want to do it through regulating the banking sector like public utilities, or maybe they'd want to do it by increasing the public banking sector, versus, making everything nationalized state-owned banks. But these are all options that exist that are different than what we're doing today. And just to show you, to bring this up to like a social, ecological, environmental issue, China used this system to dramatically increase lending into clean energy investment as a public priority, policy priority in 2020. And we're able to triple the amount of investment going into the clean energy sector in China, which was already the highest level of investment in the world. And by 2024, they have been achieving declining emissions, which is a first among large industrial countries. So I've said this already, but which system, is best depends on your perspective, depends on really your values and your concerns. And as I've said, my goal and our goal in this presentation isn't to push any one of these. Our goal is to provide you with the opportunity to understand the situation and the options well enough to be able to make, an opinion of your own. But what you could do, and what we do in the Money Justice Collaborative, is look at these and say, okay, well, if we line these up against our values, and so some of our values are fairness, public accountability. We think that the money supply that we all have to use in order to pay our taxes and pay for our bills should be something that's accountable for the way that it's being managed, socially responsible and environmentally responsible. These are some of our values. And when we look at these different systems, we look at the private for-profit banks and we say, well, yeah, this isn't totally fair that private, shareholders are getting the profit from issuing the money supply. It's not very publicly accountable. There's a lot of data missing and accountability missing. And they're not obligated and often are even incentivized to go in the opposite direction of taking into account social and environmental responsibility. So, and we're not alone in this judgment. We've actually done research where we've had other people, kind of do these types of analysis. And then we go, okay, how about private banks as public utilities, regulated as public utilities? Well, that's still not exactly fair for private households, shareholders to be making money off of issuing the public money supply. But at least it would bring a level of public accountability and social responsibility, environmental responsibility to the system that isn't there in the same way today. If we go to state-owned national banks, nationalizations, or what China's done, maybe that's a little more fair in the sense that, if you look at the fiscal budgets of governments, whether it's democracies or a country like China, spending in fiscal budgets overwhelmingly is progressive. It is anti-inequality. You have your healthcare spending, you have your housing spending, you have public transportation spending and things like that. So even if it's not a perfect system, if you look at the way governments spend money, it's likely to be fairer than a system that is privileging high wealth households with the investment flows. And finally, there's the option for not-for-profit public banks. So it's talking about, like, instead of concentrating, I have many tens of thousands of small credit unions, cooperatives, municipal banks, and so on. And we think that that's far more fair. It's much more publicly accountable. The decision makers are going to be accessible to the people living in local communities that, they sleep in the same communities, they go to the same schools, the decision makers. And they are therefore far more likely to take into consideration social and environmental considerations that would impact their local communities. As I said, we've done research with focus groups and surveys, and what we found is that these evaluations that we're giving here strongly reflect what we get from everyone. People generally rate the private for-profit bank money creation system the worst, without any prejudice from us. We simply ask them, who do you think should be the one issuing the money supply into your economy? And locally controlled institutions that are not-for-profits are the most highly rated. It's important to say that everything I've just presented here is just 4 options, right? There are many, many more. As I mentioned, there are indigenous money systems and other systems that have gone away. But there are also systems that I mentioned that have been part of our history that that have been very successful. And one of them that is popular if you move into the space is called sovereign money. And that's the wild idea that the money supply should work the way that most people believe that it does today, which is that the government is the one creating the money and putting it into circulation when it spends, and not when it borrows or goes into debt. And you have money in the economy that's circulating, as an asset rather than as somebody else's debt. And we have two examples of that here in the United States where I live: the paper money of the American colonies and the greenbacks that paid for the Civil War. These have been much maligned by economists and financiers and others that don't want to see public money. But in fact, there are histories that have been written of both of these that argue that they were incredibly successful, as I mentioned in one of the other presentations, and that much of what has been blamed on them for inflation and so on was coming from other places. So that's it for today. Just looking ahead, some things that you can look forward to in future videos. One is, what are some current initiatives underway and the political strategies that are being pursued to make progressive monetary reforms today of the type that I've just talked about? This, as I mentioned earlier, these systems are constantly being contested. This legal privilege, the discretion that banks have within this legal privilege, constantly being contested. There are groups that are already weighing in that process with proposals such as some of the ones that I talked about today, like regulating banks as public utilities. That's actually, there's book length and legislative proposals put forward by Morgan Ricks, who I quoted earlier, who's the former U.S. Treasury Senior Policy Advisor during the Dodd-Frank negotiations. So we'll look at that. And then also, I just mentioned, inflation. One of the things that comes up in this conversation about money creation constantly is this idea that money creation causes inflation. Well, as you've just seen, $21 trillion is being created every year and put into circulation in the United States, and similarly large numbers in other countries by relative scale. And so clearly, the story of inflation cannot be a simple story of creating money causes inflation. There's huge amounts of money being created all the time. And in years when we have inflation and we don't have inflation, right? There was very, very little inflation from 2016 to 2019. And yet huge sums of more money was being created every year than existed in circulation at any snapshot in time, according to the Federal Reserve. So there has to be something else. There has to be more to the story than just money creation causes inflation. And so we're going to look at that. It's a really important myth to break in order to be able to consider some of these other options without fear. And not just break the myth, but also gain the proper understanding with which to be able to identify the causes of inflation, because there's more than one, there are at least a dozen, and be able to identify the correct toolkit of remedies for the specific causes of inflation that do exist. And then the last thing we're going to do is we're going to offer you some tools like what we just showed you at the end here to compare and understand different money system designs and be able to predict, based on their designs, what are the kinds of outcomes that we could expect for social, economic, and environmental concerns. So those are all things you can look forward to. And that's it for today.